Welcome to Internal Controls Every Accountant Should Know. Whether you're an aspiring accountant or an experienced professional, understanding the essentials of internal controls is fundamental for safeguarding assets, ensuring accurate reporting, and supporting your organization's success. Today, we'll break down the most important concepts so you can put them into practice confidently. Let's start by looking at today's agenda and what you can expect to learn in this session. Here's our roadmap for today. We'll begin with an introduction to internal controls, what they are and why they matter. Then we'll discuss different types of controls and real-world examples. We'll explore what makes up the control environment and why it's critical for reliable operations. And next, we'll highlight essential control activities you need to know. We'll tackle risk assessment strategies, how to spot risks and respond. We'll explain how to test and monitor controls effectively. Finally, we'll talk about technology and automation's expanding role in controls. With the agenda in mind, let's dive right into the foundation. What are internal controls and why should every accountant care? Internal controls are more than rules. They're the lifeblood of reliable financial operations. They help organizations safeguard their assets, ensure every report accurately reflects reality, and keep everyone compliant with regulations. By building a solid internal control system, companies prevent fraud, reduce costly errors, and avoid inefficiencies that erode trust. For accountants, mastering controls isn't optional, it's vital. Effective controls build confidence among stakeholders and promote accountability at every level. As financial professionals, it's your responsibility to understand, implement, and routinely review these safeguards so your business stays resilient and can achieve its strategic goals. Now that we've set the stage with what internal controls are, let's unpack the main types and see how they work in practice. Internal controls fall into three broad categories, each addressing risk from a unique angle. Corrective controls come into play when something goes wrong. Think of them as the fixers. They help identify mistakes, ensure things are properly documented, and support ongoing improvement in financial processes. Detective controls operate like internal detectives. Regular account reconciliations, audits, and reviews are essential here. Their job is to spot errors early, before they become bigger issues, ensuring the integrity of your data and boosting organizational confidence. Preventive controls act as the gatekeepers. These procedures aim to stop problems before they happen by requiring things like approvals and authorizations on transactions. By layering these control types, companies limit exposure to risks and build strong accountability across their organization. Understanding control types is just the start. Next, let's look at the control environment, the context that makes controls work effectively. A robust control environment is the bedrock for all effective internal controls. It shapes behavior, defines policies, and establishes expectations. Organizational communication and information are key. Clearly defined structures, documented policies, and transparent reporting lines make controls practical and ensure everyone's on the same page. When tasks are split based on roles, it further minimizes risk and makes resource allocation more effective. Culture and training are equally important. A strong team culture and effective communication empower staff to own their responsibilities. Regular onboarding and ongoing training ensure everyone understands standards and best practices in daily operations. Ethical leadership sets the tone for accountability. When leaders model strong values, clear policies, and ethical behavior, it influences the culture throughout the organization, helping to maintain integrity and trust. Now that we understand the foundation, let's move into the specific control activities accountants should perform daily. Reliable control activities are the operational backbone. When designed well, they safeguard assets, maintain transparency, and guarantee accuracy in financial transactions. An authorization requires that someone reviews and approves transactions before they're processed. This oversight reduces errors and misuse, ensuring financial activities remain legitimate. The reconciliation involves routinely verifying accounts and inventory. It's about catching discrepancies early, supporting accurate reporting, and preventing losses from theft or mistakes. A segregation of duties means splitting critical responsibilities like approval and record-keeping among different people. This approach minimizes risks and simplifies the audit process. Documentation ensures all transactions have a paper trail, like invoices or receipts, strengthening compliance and making processes transparent for future review. Of course, no system is immune to risk. Next, let's explore how to identify and address risks through strong assessment strategies. Risk assessment isn't just a one-time event. It's a continuous process to keep your company's assets and financial information protected. First, assess risks regularly to spot new threats as they emerge. Accountants should examine both internal and external factors that could impact reliability. Second, monitor controls using performance benchmarks and reporting tools. By tracking control effectiveness over time and reacting to gaps, accountants maintain high standards. Finally, mitigation involves organizing plans to rank risks and allocate resources. The goal is to reinforce important controls before major exposures can affect the organization. With risk management in place, it's critical to continually test and monitor those controls. You can't improve what you're not measuring. Continuous improvement relies on ongoing evaluation of controls. Regular testing makes operations more reliable, reduces errors, and strengthens compliance. Testing involves sampling transactions and processes to confirm controls work as intended. Sharing findings with stakeholders keeps everyone informed and ready to act. Follow-up means promptly addressing any exceptions or issues found. Corrective actions, paired with root cause analysis, prevent future problems and help build better processes. Monitoring is an ongoing effort, scanning for new risks and opportunities, whether that's automation or redesigning a process. Reporting rounds things off by summarizing test results and recommendations. It also means escalating issues to management so accountability is clear. Timely reviews are crucial. They optimize processes and reduce operational risks. In today's digital world, technology and automation play an increasing role. Let's wrap up by examining how modern tools can enhance your internal control system. Modern accounting is powered by digital controls, and leveraging them is vital for resilience and best practices. A workflow automation streamlines repetitive tasks, creates thorough audit trails, and flags unusual activity in real time. This allows for quicker follow-up and regulatory compliance. Cybersecurity safeguards data integrity. With tools like user authentication, role-based permissions, and system audits, businesses protect themselves from unauthorized access or tampering. ERP systems and integrated workflow solutions automate key approval and reconciliation processes. This frees up accountants for strategic work and reduces human error, while robotic process automation, RPA, adds even more efficiency. Automated controls bring huge advantages in accuracy and auditability, but it's important to keep evaluating these systems and maintaining robust cybersecurity protections. Thank you for joining us on this journey through internal controls. By understanding and applying these principles, you'll lay the groundwork for reliable, transparent, and secure financial operations. If you found this helpful, be sure to subscribe for more insights on practical accounting and finance topics.